Ladies and gentlemen, good day and welcome to the Ajanta Pharma Q1 FY'25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Yogesh Agrawal, Managing Director of Ajanta Pharma Ltd. Thank you, and over to you, sir.
Thank you. Good evening and welcome to all of you. With me, I have Mr. Rajesh Agrawal, our Joint Managing Director, Mr. Arvind Agrawal, our CFO, and Mr. Rajiv Agrawal, our AVP Finance and Investor Relations. I hope that the results are already with you by now. We will take you through business-wise performance for the Q1 of the current year, along with the comparison of the previous year same period. FY'25 started on a good note for Ajanta Pharma, with notable achievements in first quarter sales, PAT and EBITDA. Branded generic business saw a healthy growth of 17% on the back of our strategic approach and focused execution. Our consistent efforts yielded commendable results, maintaining our position as a leading player in the pharmaceutical industry. Furthermore, our EBITDA margins expanded to 29%, reflecting our commitment to operational excellence and efficiency. Our ability to enhance profitability while maintaining financial discipline saw our PAT margins improve to 21% from the previous year's 19%. One of the significant achievements during the quarter was our cash conversion ratio of 141%, which was possible through our concentrated efforts of improving working capital cycle. This will certainly help us to improve our returns on investments going forward. We are confident of sustaining this momentum and driving continued growth in coming quarters. Our excellence in terms of strategy and operational execution will enable us to deliver long-term value to our shareholders. Moving on to the business details, during the quarter, revenue from operations was at rupees 1145 crore, a healthy growth of 12% from our total business comprising of three verticals: branded generic business, US generics, and institution business in Africa. During the quarter, 76% of the total sales came from the branded generics, which is spread across India, Asia, and Africa. The sales stood at 860 crore, posting 17% healthy growth during the quarter. This business exhibits assurance, sustainability, and potential for the long-term growth. Let me now take up the international business, and I will first start with the branded generic business in Asia and Africa, which contributed 45% in the total revenue. Let's begin with Asia. In Asia, our presence spans across the Middle East, Southeast, and Central Asia, encompassing around 10 countries. In Q1, sales was rupees 277 crore against 254 crore, a growth of 9%. We launched 7 new products during the quarter in the region. Africa business is spread across 20 countries. In Q1, our sales was rupees 230 crore against rupees 159 crore, posting a very healthy growth of 45%. We launched 2 new products during the quarter in the region. The higher growth during the quarter was the result of lower sales in Q1 FY'24 due to pension reform strike in France and Red Sea crisis. Let us talk about other 2 verticals of international business. I now move to US generics. US generics contributed 20% to the total revenue. In Q1, sale was rupees 228 crore against rupees 213 crore, posting a growth of 7%. The growth is in line to our guidance of mid-single digits, as most of the launches are skewed towards the last quarter FY'25. Our superior execution continues to keep us a preferred partner of choice for the distributors. In Q1, we filed 2 ANDAs, received 3 final approvals, and launched 2 ANDAs. we have 46 products available on shelf and 21 ANDAs awaiting approval with US FDA. We target to file 8 to 12 ANDAs in the current year. I now move to Africa institution. This business contributed 4% in the total revenue, which comprises of anti-malaria products. In Q1, sale was rupees 42 crore against rupees 45 crore, posting a degrowth of 36%. The sharp degrowth was due to preponement of few supplies in Q4 of FY 2024, as mentioned at that time. This business remains unpredictable due to reliance on procurement agencies' schedule. Now I invite Mr. Rajesh Agrawal, our Joint Managing Director, to take you through India business. Thank you, and over to you.
Thank you. Good evening to all of you. I am delighted to share key highlights of the India business. Our performance has been excellent on the back of increased volume, price increase, and new product launches. India business contributed 31% in total revenue. In Q1, sales was rupees 353 crore against rupees 319 crore, a growth of 10%. India business includes revenue from trade generic, which contributed rupees 41 crore against rupees 36 crore in Q1 in same period of FY 2024. During the quarter, we launched one new product, which was first time in the country. We continue to outpace IPM by 130 basis points, with Ajanta growing at 8.9%, surpassing IPM growth of 7.6% as per IQVIA MAT June 2024. This trend extends to most of the therapeutic segments we are in, where our growth has consistently outpaced the segment growth. In cardiology, our growth for the quarter as per IQVIA was 15% against IPM growth of 12%. Though on MAT basis, we still lag due to the price impact in one of our major products. In the covered market, we continue to be the fourth largest in IPM and among top 10 in all our therapeutic segments. As per IQVIA MAT June 2024, our faster growth is contributed mainly by new launches, which was about 1.3 times to the IPM. We have now 4 brands in top 500 list. In our sales breakdown, cardiology contributed 38%, ophthalmology contributed 31%, and dermatology contributed 23% of our India business, with remaining 8% coming from pain. I now invite Arvind Agrawal, CFO, to take you through the financial performance. Thank you, and over to you, Arvind.
Thank you. Good evening and warm welcome to the first earnings call of FY 2025. On this call, our discussion includes certain forward-looking statements which are projections or estimates about future events. These estimates reflect management's current expectation about future performance of the company. These estimates involve number of risks and uncertainties that could cause our actual results to differ materially from what is expressed or implied. Ajanta does not undertake any obligation to publicly update any forward-looking statement, whether because of new confirmation, future events, or otherwise. We will look at the consolidated financials and provide year-on-year comparison. The key financial highlights of Q1 FY 2025 are as follows. Total revenue stood at rupees 1145 crore against rupees 1021 crore, posting growth of 12%. We expect our overall revenue to grow in low teens in FY 2025 on the back of mid-teen growth in branded generics, mid-single digit in USA, and degrowth in Africa institution business. Our gross margin stood at 77%, an improvement of 200 basis points from FY 2024. The same was due to higher contribution of branded generic business in overall revenue. We expect it to remain in the similar range or 50 to 100 basis points movement due to change in product mix. Personnel cost was at rupees 284 crore, an increase of 33%. This increase consists of regular annual increments and one-time charge of about rupees 30 crores for change in gratuity policy of the company, where we have removed the cap of rupees 20 lakhs for individuals for their gratuity eligibility. R&D expenses was 4.5% of total revenue. In Q1, expenses was rupees at 51 crores against rupees 55 crores. We expect the expenses to be at 5% for full year. Other expenses in Q1 stood at rupees 263 crores against rupees 285 crores in previous year same period. We expect the expenses to go up in coming quarters in the range of 26 to 27% due to increased R&D and SG&A expenses. We achieved EBITDA margin of 29% in Q1. EBITDA stood at rupees 330 crores against rupees 271 crores, a growth of 22% over previous year. We expect the EBITDA to be around this range, plus minus 1% for whole of 2025. Other income was at rupees 26 crores in Q1, which includes forex gain of rupees 8 crores. Income tax stood at 24% during the quarter, and we expect the same to be for FY 2025. In Q1, PAT was at rupees 246 crores against rupees 208 crores, a growth of 18%. PAT stood at 21% of revenue from operations. We incurred capex of rupees 60 crores in Q1 FY 2025. Capex, including maintenance capex for FY 2025, is estimated to be at around 175 crores. In Q1 FY 2025, we have generated a healthy cash flow from operations of rupees 466 crores with cash conversion ratio of 141% and free cash flow of rupees 301 crores with 123% PAT conversion. This is the result of our consistent efforts in improving working capital cycle. With these highlights, I open the floor for the question and answer. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abdul Qadir Puranwala from ICICI Securities. Please go ahead.
Yeah, hi sir. Thank you for the opportunity and congratulations on good set of numbers. So my first question is with the Africa branded generic business. In your opening remarks, you alluded to a lower base, but even if we see from a historical run rate perspective, we have done substantially well this quarter. So going ahead, what is the kind of revenue run rate we should see in this particular segment?
Yeah, so I think, as I mentioned, some of the sales got spilled over from the last quarter of Q4 of the previous year. And because of that, this quarter looks a bit elevated. So I think if you see historically, our average run rate was around 155 CR to 160 CR. As I think we've given the guidance for the blended branded generic business across India and across all the international markets, we are looking to post mid double-digit growth. So I think considering Asia, Africa, we are heading towards delivering that kind of number. I think that's what is the outlook.
Got it. Helpful. And the second question is with relation to your working capital. So, with the kind of that you have done this particular quarter, would you like to highlight some measures that you've taken to curtail down on your working capital or some change in policy which has led to this kind of an improvement?
See, basically there are two areas in the working capital cycle. One is the inventory and another one is the debtors, receivables. Now, on the inventory side, anyway, our consistent efforts are happening in terms of all the efforts which are being done to reduce the inventory level at every locations and every point. While that is being done, The receivable is something where we have been able to achieve some improvement, especially on the US side. And this is where we is getting reflected in the cash accrual.
Got it. And so my final question on the gross margin guidance of between 75-76%.
Yeah.
So I mean, if we allude to the kind of growth to what you're guiding for, then largely the kind of mix what you're seeing in this particular quarter should sustain for the full year. So I mean, any reason why we are being a little conservative here on guiding for the gross margins when we already about the threshold as compared to what we are guiding?
See, as I mentioned in my this one, actually I am saying that it can be plus minus 1%. So the contribution of branded generic of 77% may reduce as we go forward with higher contribution from US or institutional business. So in that case, this variation can take place. But otherwise, we are inconsistent with the number which we are talking about.
Plus the expenses during the quarter, they had it slightly on the lower side, which we expect that in next 3 quarters, those expenses will slightly elevate. So that will also have an impact on the
On the EBITDA, yeah.
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 Got it. Okay. Thank you, Ajanta.
Yeah.
Thank you. Participants who wish to ask questions may please press star and 1 at this time. The next question is from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity. Sir, just first of all, I missed on the opening remarks about the employee expenses. If you could just repeat the same.
See, basically in the employee expenses, there is one-time charge about 30 crores which is there. This is because of the change in policy of gratuity being paid to the employees. Earlier we had a limit of 20 lakh rupees for the gratuity for the employees whenever we are giving it to them when they are retiring or resigning. Now that cap of 20 lakhs has been removed, and because of that the provision for gratuity has increased. So that provision is something which is one-time charge which has come in. Now it will get normalized in the subsequent quarter.
So we should be broadly 250 crore plus minus per quarter for the employee expense.
Yes, you are right. You are right.
You should minus 30 crores to kind of get a run rate for the running quarter.
So sir, if given the product mix, if we are able to sustain the gross margin, and even if I assume, let's say, 10-15 crore increase in other expenses, still we should be doing much better in terms of the EBITDA margin. So what is holding us back for the forthcoming quarters of full year of FY'25 from having a better profitability or a better margins?
No, as I mentioned, the expenses were very low in the first quarter. I think as we go along, the expenses will pick up, the other expenses. So in that case, our expectation is that the EBITDA margin should be in this range or plus minus 1%.
And so how much was the trade generics business for the quarter in India?
Yeah, it was 41 crores this quarter as against 36 crores in the last year same quarter.
Yes, sir. And lastly, how are you seeing the base business as far as US is concerned? Is the price erosion sort of stable at say mid-single digit or getting higher, or if you could shed some light there?
Yeah, price erosion is stable. It remains to be in the high single digit. There is no aggressive price erosion or any kind of things up there. So for now, I think the market seems to have stabilized quite well.
Understood. Thank you. That's it from me.
Thank you. The next question is from the line of Gagan Thareja from ASK Investment Managers. Please go ahead.
Good evening. Hi, I'm audible.
Yes, please.
Yes, sir, on the Africa branded generic piece, it has been fairly volatile across the quarters, even in the past, and you have alluded to channel filling and, destocking. kind of playing in how the numbers behave across quarters. Is there something of a similar nature in this quarter?
Yeah. As I mentioned in the opening remarks, this quarter looks a bit elevated because some of the sales of the last quarter got factored in, it got accounted in this quarter. But historically, if you see, we have delivered a CAGR of about 13% to 14% growth for last 5 years in Africa, if you remove quarter to quarter or 1 year to second year. I think this kind of volatility can happen. One quarter maybe for XYZ reason, channel filling, defilling, any issues there, like we had a Red Sea crisis or the strike in France. That does impact. I think we have to look at a longer horizon of 1 year or maybe multiple years. I think the fundamentals remain strong to deliver the mid-teens growth there.
Okay. When you say that branded generic market sales for you will grow at mid-teens, will it be mid-teens across all the 3 markets, India, Africa, and Asia, or are we sort of seeing different numbers?
We are getting the mid-teen growth guidance for the branded generics in emerging markets, which is Africa plus Asia.
Okay.
That does not include India.
All right.
Yeah.
If I look at this year's sales mix, given your guidance of higher growth in branded generics versus institutional and US business, which are relatively low margin businesses, it would intuitively seem that the sales mix should lead to better margins year on year. In addition to that, you have added to your sales force in the past year in the African market, Asian market, and which should see an improving PCPM. If you reason it out, it would seem that there should be a good strong case for margin improvements. Is that line of thought wrong?
No, I think that line of thought is not wrong, because as we said, 29% EBITDA in this quarter is something which is very clearly seen. As I mentioned in the opening remarks, I think plus minus 1% is the variation which can happen. Otherwise, it is something which is going to be there.
Plus one, I understand, sir. Minus is something that hard to understand given the way things are moving for you, unless of course there are some force majeure conditions or things.
Exactly.
Because distribution business is not in our control, what orders we will get. The US is an unpredictable market, which can happen. There are many other factors for the supply chain in the emerging markets. We have to factor in for any volatility which can happen, which is unforeseen.
Are freight costs in any way impacting you in 1Q, or do you foresee them impacting you going ahead on a year-on-year basis?
Yes, on a year-on-year basis, I think what we have seen the freight costs go up in Q4. So far in the Q1, they have remained at the similar level. They have not aggressively gone up. But on an annualized basis, we believe that we would be adversely impacted by 30 crores in the freight cost as compared to the full year last year and current year last year. We'll have an extra freight of 30 crores.
Right. And from a sales force point of view?
Assuming that the freight level remains at the current level. If they go up or down, accordingly the impact will change.
And in terms of sales force addition, what are your planned additions this year in India and the other markets?
In India, there is no increase in the field force we are estimating. In the emerging markets, we could have an increase of the field force of about 8 to 10%. But that could happen towards the later part of the year. May not be significant in the current quarter and the next quarter. I think most of the addition will happen towards the end of the year, maybe third quarter or fourth quarter. Against the 1,800, probably we could add another 100 to 150 people.
Right. And finally, what is your capacity utilization? A broad sort of indicative number.
about 60 to 65% across the plants.
Okay. Thank you, sir. I'll get back in with you for more. Thank you.
Thanks.
Thank you. Before we take the next question, we would like to remind participants that you may press star and one to ask a question. The next question is from the line of Sudarshan Padmanabhan from JM Financial PMS. Please go ahead.
Thank you for taking my question and congrats on good set of numbers. So my question is to understand, cardiovascular, business of ours. I mean, the last 2 to 3 quarters, we basically seen the growth a bit muted. If you can give some color with respect to, now that, we have been adding MRs and, the other segments, specifically the derma, continues to remain pretty strong. How do you see this segment gathering momentum and what actions have you taken there, sir?
The prime reason for the subdued growth that you see in cardiology segment is because one of our largest brands, the largest brand for the company, Metexcel, had come under the further price reduction by NLEM in the last year. And that impacted us until March of 24. And that's why you see a subdued growth, because we were the price leaders and we took a sizable hit on the Metexcel top line as well as, of course, getting added into the bottom line. But after that, if you look at the Q1 of the current year, which is April-June quarter, our growth in Metexcel and overall in cardiovascular segment is much better than the IPM and the likewise molecule growth. So that was a minor aberration that happened, but we don't see any major challenge in the cardiology segment. As I said, the growth has bounced back. We have grown at 14.8% as against 12.2% of the cardiology segment in the Q1. So we have grown faster.
I think the price cut would have helped us to gain market share, being the market leader. So that is visible in the first quarter, I would assume.
Sorry, I couldn't hear you clearly. Has the price cut?
Yes, sir. The price cut, see, normally, when the market leader takes a price cut and they have such a strong market share, eventually with the lag, we will start getting the market share back. So that would be visible probably in the first quarter, and we should gather momentum as we move to the second and third quarter. Is that right, sir?
Yeah, we are quite hopeful. All the efforts are on to build the momentum up.
Yes, sir. And second is, sir, one thing, I was pretty happy to see on the annual report that, we had 14 launches and some of the launches that we had were first time in India. If you can give some color with respect to, how are these 14 molecules doing? And how many more launches have we seen in the first quarter or we plan, say, in the first half of this year, sir?
On a blended basis, if you look at the growth composition of Ajanta versus the IPM, our new brand growth has been, contribution from the new product launches has been better than the industry growth by 1.3 times, as I mentioned in my opening remarks. Which, as I said, gives a very encouraging picture of how we are able to perform in all the new brand launches that we have undertaken in the last 12 months to 24 months also. We have a robust pipeline, and I see that these brands can become very important and significant for the company in the coming few years.
Sir, one final question before I join back is, the Africa branded has rebounded very sharply. I mean, after, majority of FY'24 days or some kind of channel inventory. Is this quarter more or less a reflective of what we can achieve, say, in the next, on a quarterly basis? Or is there been any kind of a front loading in this quarter in terms of the run rate, sir?
As I again clarified, our run rate was about 155 crores per quarter. So if you see last 3 quarters, that was the run rate. Last Q4 was at 110 CR odd. So we had a drop on the quarter, and as I said, some of the sales got pushed into this quarter. So this quarter, I think you should add in the last quarter and work out the average, and there was a growth in that. Of course, there was a healthy growth, despite the fact that the sale got added in this quarter. We feel confident of posting a decent growth in the Africa. But I think the way I would say, I would urge you to look at our branded generic business in emerging markets is look at the blended basis. Sub-Africa at times may grow faster and Asia may be slightly behind, or Asia may grow faster than Africa. But the right way, the whole DNA look is the same, the gross margins are around the same. So I think on a blended basis, we are giving the guidance of mid-teens growth for the branded generic business of the emerging markets.
Sure, sir. Thanks a lot, sir. I'll join that.
Yeah. Yeah.
Thank you. A reminder to the participants that you may press star and 1 to ask a question. The next question is from the line of Vishal from Systematics. Please go ahead.
Thanks for the opportunity. Sir, with respect to the branded generic markets, Africa and Asia, would you be able to share some color as to what is driving the growth? So basically, whether it is a market expansion, getting into new geographies, or it's a large part of it is basically volume and value growth in existing markets. And do you get the same kind of price increase in these markets as you get in India?
Yeah. So it is largely a factor of increased market share from the existing products. As you know, we have added people in our international markets last 2 years. So that is also reflecting. And the third factor is we are continuously launching new products in this market. So all these three are driving the momentum for the growth. So if you see, last year we've added 18 products in Asia. We launched 9 products in Africa. So put together almost 27 products got launched. And already in the current year we have launched 7 in Asia and 2 in Africa. So 9 products got launched for the quarter. So if we are able to add similar kind of products, it takes time for them to nurture and grow. But it just adds up every year. All these 3 factors get added into that. There is not such a big price increase in international markets that luxury or that comfort is not there. So most of it is new products or increase in the volume of the existing products.
Right. And so some sense on how these markets are versus India. So do you find these markets as competitive as India is? Or currently these are less competitive and you have more space in terms of launching new products in these markets, emerging markets and Africa?
No, it is as competitive. It is as competitive as it is in India. Everything is to be fought and gain the market share. Having said that, we believe that we have a very good skill set to identify the gaps in the market and bring the products, get the registrations and bring them to market and make it go a successful brand. So we are very strategic in product selection, adding to our various teams and making a sizable brand out of it. Yeah.
Right. And so just one final question. On India, what we are witnessing is companies are either trying to add MR teams or they are acquiring other companies, smaller companies. So we are doing neither. So we are neither adding MR nor we are looking at any acquisition. So how are we? But we are still growing faster. But how do we intend to sustain this, considering the growing competitiveness?
No, the plans are always on. We are always evaluating and looking for opportunities. Also, not only in terms of acquisition, but also there are strategic additions in the MR counts which are being done. We already have a good optimum coverage. We are rather focusing on increasing the productivity per rep. That is really the focus for us for the last few years. And we are on a constant evaluation. If there are opportunities to further strengthen the segment or any other new segment, then we will at the right point in time enter those segments.
Got it. Oh, thank you very much.
Okay, right.
Thank you. Participants who wish to ask questions may please press star and 1 at this time. The next question is from the line of Gagan Thareja from ASK Investment Managers. Please go ahead.
Thanks for taking my question. But most companies who have, high salience in emerging markets have, reported poor growth because of adverse currency movement. whereas that has not been the case for Ajanta. So can you perhaps elaborate on, what was constant currency and how, and what has been the impact of currency movements in these markets for you?
See, currency movement is something which is not very substantial at all. It is something which is the normal growth which we have got through volume. As MD mentioned earlier in his opening remarks, we are consistently increasing our market share. We are consistently launching new products, and all that is giving us the growth. So it is not just the currency, thing which is coming into the picture.
No, I get that. My question is more in the sense that how much of your sales is, completely hedged for currency movements and how much.
Okay. So currently we are hedged for about 6 months sales already. And going forward, we, depending on what the view is on the currency, we normally take the hedge even for 9 months or 10 months also.
Okay. And coming to the India business, where you have sort of focused on 4 therapeutic areas, is it possible to understand to what degree you have been able to sort of broad base your portfolio of products in these 3-4 areas, and do you also intend to come into new therapy areas in the coming 2-3 years?
So the first part of your question, in different specialties, we have different coverages. For example, in ophthalmology, we are second ranked by way of sales and first ranked by way of prescriptions as per SMSRC audit. Now, in that particular segment, we have close to 70% of the market coverage of being in those therapeutic segments, whether they are NSAIDs in ophthalmology or antibiotics or anti-glaucoma, so on and so forth, right? So we have a large coverage in ophthalmic. Whereas if you look at some of the other segments in cardio and derma, we have a relatively smaller presence because the way it has evolved, and we have entered at a point in time where we could not launch the older molecules. Answering your second part of the question, obviously, as I said just now, we are evaluating different therapies every quarter and every 6 months. And if we find the opportunity, then we will for sure launch those specialties and into some of the new specialties in the coming year or so.
Right.
Yeah.
Thanks for that. And for US, while this year you are talking of mid-single digit sort of growth, with 8 to 10 filings, if I heard it correctly, how should, one think for Ajanta's US business, in a 3 to 5 year time frame?
Well, that's a very long outlook. We normally don't give that kind of guidance. We stick to the current year. Having said that, you can factor in the number of, we've already shared the number of ANDAs awaiting approval and number of ANDAs which we are targeting to file current year, and that should be the rate for next 2 years also. So a lot of products will get launched, and as I said, current year also a good number of launches will happen towards the Q3, Q4. So that the factor will come into the next year. So just general my sense is, I think next year our growth in US should be in double digits, but I'll hesitate to give any kind of specific, whether low double digit or mid-teens or high teens. But I think outlook looks positive to us.
Okay. And for the emerging markets, do you intend to increase presence or maybe add new markets or new countries there? I mean, in Asia, I think Philippines is large for you, followed by some of the Middle Eastern markets and CIS.
We have started to build, we have started to look at some of the markets. Central Asia is our next thrust right now. So we are in the active phase of ramping up our presence there by filing a lot of product dossiers. And as the product gets approved, then we will add the people to promote them. We are looking at Anglo-Africa also to add there, increase the product portfolio. Some other geographies are also there in Asia, but it's a bit too early. We have just identified the product, start filing there. It may take 3 years by the time we get the approvals and we start to commercialize. But yes, to answer your questions, there are some countries which are at advanced stage where we filed the dossiers. Approval should come in 12 months to 18 months. Some we will file or we have just filed, so that may be 3 years. So there are different markets and different maturity curves which will fructify in next 1 year, 2 year, 3 years.
Okay. But you don't intend to get into any of the LatAm markets?
Honestly speaking, I think the way we have prioritized our entry, there are certain number of markets which we believe where we have good understanding and skill set and they'll be easy addition to us as compared to going to Latin America, which will be a very completely new market, and with the same resources, it will take longer time for us to ramp up there. So I think there is enough work for us to do for next 2 years in the geographies which we are present in, that is Africa and Asia and the Middle East. Once we are probably at advanced stage of filing dossiers, then we will look at Latin America.
Okay. And in India, do you feel the need to add to your sales force, not this year perhaps, but next year?
Yeah, maybe in the next year as we go along, we will evaluate further by the end of the year, maybe quarter 3 or quarter 4 we'll evaluate. But we are doing strategic additions if required. Nothing in major numbers. Yeah.
Okay. So even if there is a sales force addition in FY'26, it will be, not a very significant number is what you're saying?
We don't foresee a significant number. Basically, again, productivity is what we are focusing on. So, and we are gaining good momentum into that. So it's fine.
And what's the PCPM for your India business currently?
PCPM, 1 minute. I'll just 4 lakhs for the end of first quarter. PCPM has touched 4 lakhs.
And what was the number for 1Q last year and whole of last year for that?
Year on year, Q1 it was 3.5 lakhs. Sorry.
And for the full year, FY'24?
Sorry. So FY'24 was 3.5 lakhs and current year first quarter is 4 lakhs.
Okay. Fine. Thanks for taking my questions. I'll get back in with you. Thank you.
Okay. Yeah.
Thank you. Participants who wish to ask questions may please press star and 1 at this time. As there are no further questions, I would now like to hand the conference over to Mr. Yogesh Agrawal for closing comments.
Thank you everyone for joining this call. In case if there are any further questions that remain unanswered today, please reach out to our investor relations team. Thank you.
Thank you very much. Thank you, everybody.
On behalf of Ajanta Pharma, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.